show this morning on our Facebook page where we stream we stream our show live every day, by the way. So if you're listening on the radio and say, hey, I missed something, or I'd like to see the charts you're talking about, whatever, you can go to our YouTube page on our website, or our podcast page on our website. And you go to realinvestmentadvice.com, but click on the YouTube page, click the link there. You'll subscribe to our YouTube page, and then you can watch our show stream live, or you can watch it at your convenience and see all the graphs, the charts that we talk about, etc. as we go along. We also get good comments during this show from all over the place. So we had one a few minutes ago said, would you please share your dollar hedge with me? I'm going to do something here I don't normally do. I'm going to share with you the inside secrets of portfolio management and how to hedge. So here's the secret to a dollar hedge. Ready? Write this down. Buy the dollar.
Yay,
okay.
Finance!
So I'm joking. I'm not joking. That's all you have to do. I mean, it's just it. What you're looking for to hedge with in a portfolio is always something that does the opposite of something else, right? So that's what a hedge is. So what drives gold prices and other commodities up and down is dollars, because the dollar is what every commodity in the world is traded with at any point. So if I want to buy, let's say I live in Zimbabwe, right? And I want to buy gold. I want to buy oil or gold, right? Pay for it in dollars. Nobody wants Zimbabwe currency, right? Because it's like like $1 is worth like $1 billion Zimbabwe dollars. So everything in the world trades in dollars. If I'm in Britain, if I'm in Russia, if I'm in China, if I'm in Germany, all in dollars. So there's a historically long correlation between commodities of various types and dollars. So they tend to move opposite of each other. A weaker dollar allows people to buy more of a commodity because there's using less dollars for that, and vice versa. Okay. So if I want to hedge gold or oil or commodities in some form, then in other words, hedging means I want to limit downside risk. Then I want to go long the U.S. dollar, and that's what we've been writing about in our newsletter for the last couple of weeks, is that we added this dollar hedge because dollars were 3 standard deviations oversold. Basically, that rubber band had been stretched as far as you could to the downside, and all the commodities have been stretched to the upside. So there would eventually be a reversion of these items back towards some type of support. And so when I think there's a little bit more to go, but there's not a lot at this point. So we'll probably take that hedge off here pretty quickly, but that's what we're evaluating now. And then we'll look to add more back to our gold positions and other things. But that's hedging. That's all hedging is. It's just a strategy to reduce risk in a portfolio. And this is interesting, particularly at this particular time that we live in, because of the issue of ETFs and these exchange traded funds and these passive indexes. And it's interesting because there was a chart out yesterday showing that money flow continues to come out of ETFs and index funds. And this is what's called equity flows, right? So is money moving into these things or moving out of them? Well, over the last few weeks in particular, money's been flowing out at pretty much a record pace coming out of these ETFs and indexes. Well, if money's coming out of these ETF and indexes, where are they going? Right? That's the question. They got to go somewhere. Which is going to bring me up to this money on the sidelines garbage we'll talk about in a second. So if money comes out of ETFs, then where's it going to? If we've got flows coming out, where's it going to? Well, it's going into individual equities, right? So this is the Robinhood effect, right? And we talked about this yesterday. Robinhood now has more monthly trading than E-Trade and Charles Schwab combined on a volume basis. So people are now saying, well, why do I want to own an ETF when I can go buy Netflix, Apple, whatever directly. I can just own the stocks because those are the stocks that are running. We talked about the problem of this on Monday is with 26% of the index made up of just 5 stocks. Why do you want to own the index? Just own the 5 stocks if you really want to have performance. And that's what people are doing. And so money's coming out of these ETFs and things and going into individual stocks. Now, the interesting thing about this is this has a loop effect that's going on. There are now currently more ETFs. There are 7,000 global ETFs. Actually, more than that, but 7,000. There's only 3,000 U.S. listed companies. So the problem is you've got more ETFs owning, which ultimately those ETFs own the underlying 3,000 companies, right? So you've got more and more people buying these ETFs, and they're all buying the underlying stocks, which is creating the underlying stocks going up. And now that they're selling the ETFs and chasing individual stocks, those stocks that are representing all the ETFs are pulling everything up all at once. And that's why markets are all-time highs. Even though you've got these flows that are going on, it's just moving from one area of the market to the other, but it's lifting all the asset prices at the same time because of the way we measure things. So this is why markets are sitting at all-time highs, even the fact these are all going low. But this also is the myth of the money on the sidelines issue. Also, and I've also remind me, Brand, I got to talk about stock splits here too. This is the money on the sidelines nonsense. You hear this all the time on the media. In fact, there was an article out, I think on Monday, if I'm not mistaken, on CNBC or Market Watch. This portfolio manager was like, there's trillions of dollars on the sidelines just waiting to come into the market. No. Is not true. The reason is that in order for you, let's say that you've got $1,000 sitting in your bank account right now and you want to go buy some shares of Apple. Well, in order for you to go buy shares of Apple, somebody else has to sell it. So while you may put $1,000 into Apple, somebody else took $1,000 out of Apple. There is no money on the sidelines. But Lance, prices move up and down. Surely if prices are going up, that means more people are putting money into the markets. No, that's not the case. The money stays the same. For every buyer, there's a seller. The only difference, what makes prices move up and down, and look, here's a simple way to think about this, is that if there is always an equal demand of buyers and sellers, prices would never move. The price of the market would be 3,000 on the S&P, and that would be it. And every day we open up the markets and there's an equal match between buyers and sellers, the price will not move. What drives the price up and down is when there is a mismatch in the demand for buying versus the demand for selling or vice versa. If there are more people wanting to sell stock, in other words, there's a greater supply of people wanting to sell than there are people willing to buy, buyers go, yeah, I'll buy from you, but you're going to have to lower the price. Think about negotiating for a house, right? You go into a neighborhood, and this guy's had a house listed for 12 months, hasn't had one offer on the house. What are you going to do? You're going to lowball the offer, right? He's saying, hey, I want $1 million for my house. You're going to go in and say, well, I'll give you $800,000, whatever, pick a number. But you're not going to pay list price for it. And you're certainly not going to pay a premium for the house. You're not going to go in, the guy's had a house sitting there with no offers for a year, and you go in and say, yeah, I'll pay you $1.5 million for the house. Right? He'll take it. But you're not going to do that. Conversely, if a guy lists a house in a neighborhood and there are 20 offers on the house that day, you're going to have to pay more for the house than what he's asking for, right? Because there's more demand for buying than there is the willingness of sellers, right? That's why prices move up and down. There's no more money going in or going out of the market because there's no this whole money on the sidelines myth is stupid because there's always a buyer for every seller. It just depends on what price people are willing to negotiate a transaction so that a transaction can occur. That's what drives it. So, now that we've solved that problem, when we come back after the break, we'll talk about the stupidity of stock splits. Yogi Berra had a very important saying about this, so we'll talk about that when we come back from the break. I'm your host, Lance Roberts. Don't go away.
Still, there never seems to be a single penny left for me. That's too bad.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.